In this video, we're going to talk about Aterian, trading under the ticker symbol ATER. Before the video begins, just a quick heads up that not all my videos are made on the same day they are posted, so if there are material events happening afterwards, I will make a follow-up video to reflect those changes. With that being said, let's go on to today's video. Aterian is a consumer products company. It has its brand of home and kitchen appliances, beauty products, and consumer electronics. Recently, the company has been the center of a lot of attention and speculation between those who want to short sell the company and those who want to short squeeze the short sellers. The reason behind the current dynamic is because, on one hand, the short sellers want to push the stock price lower due to the company's relatively weak fundamentals. After all, they have been for a long time incurring operating losses. They can do this by borrowing shares, sell the shares at the market rate, and recover them later on, and make money with the difference of prices between when they dump the positions and when they recover these positions and give them back to the brokers. The trading volume of Aterian has recently been 6.1 million shares, compared to an average volume of 3.7 million shares. Over the previous 52-week period, its price fluctuated between $2.86 and $48.99. The market cap of Aterian is currently at $154.2 million compared to an enterprise value of $377 million. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact the company's profitability, attractiveness, and even the solvency in some cases. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is goodwill. Goodwill is basically an expectation of the market that the company can generate more profit or to have more growth than other companies, partially because it may have a good or better management, stronger brand recognition, bigger online following, and so on. This is basically what is unique about a company in particular compared to an alternative competitor. In other words, it's not a tangible asset that companies may use. However, it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value the market gives to its assets when the debts are paid off. In case of the company goes to liquidation, goodwill would be completely depreciated, and we would be left with potentially less assets to distribute to shareholders and debt holders than the figures shown on the balance sheet. In comparison to its historical price fluctuations, the stock is 0.7% higher than the 1-month low, 0.7% higher than the 90 days low, and 0.7% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head toward, the implied volatility is 178.7% compared to a historical volatility of 87.7%. The put-call volume ratio is currently at 0.4. It is normal for most stocks to tend to have a higher put option volume than what they deserve because many institutional investors choose to hedge their exposure by buying put options. The most recent volume of options traded has been 3.1 thousand contracts within a day, compared to the 30-day average volume of 3.7 thousand. In terms of open interest, the most recent volume of open interest has been 57 million contracts, compared to a 30-day average of 61 million contracts. Regarding its shareholder structure, institutional shareholders hold about 25.3% of all its outstanding shares. The biggest shareholders include Hudson Bay Capital Management, BlackRock, and Susquehanna International. Understanding shareholder structure is relevant to an extent because it helps to determine if you should hold a stock long term or to simply view it as a short-term volatility trade. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term holding. Usually, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions since many titles are mostly held by retail traders and not institutional investors. But that tends to be the exception and not the rule. Let's also look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there are significant short interest in the total volume. It could be a sign that there is an organized shorting operation going on, like what went on with GameStop and AMC. The current short interest is 27.2% of the total float and 54.2% of all dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movement are showing, and what they can be used is that they can be used as one of the elements that determine what should be our overall approach, or at least the timing of the trade. Oscillators are showing 2 sell, 9 neutral, and 0 buy, with an overall tendency of sell. The moving averages of the past price actions show 14 sell, 1 neutral, and 0 buy. The overall tendency from the perspective of moving average is strong sell. Now keep in mind that the indicators often show what the present and the past performances are, but rarely predict accurately the future. Nevertheless, I think that they are relevant to determine if the timing of the trade is the right one. Regarding the pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $2.46, $3.26, $3.92. For the resistance level, they are $5.21, $6.55, and $7.29. Looking at the stock price of Aterian over the past few sessions and weeks, it seems like the share price has now resumed the downward trend and doesn't seem to be much support left from where it is now. The appeal of holding Aterian stock has always been the likelihood of the stock being short squeezed by those who want to push the stock upward against the short sellers, and so far it seems like this effort has been under significant downward pressure since September 2021. The current volume is not sufficient to push the stock upward, I think, at least in the short term, and this may be the long-term tendency of the stock as well. My opinion about the company is that it should remain on your list, but from a trading perspective, not a holding perspective. The stock price is very close to its floor, so we should expect additional downside to be very limited. However, given the amount of people who have a much higher cost basis, we have to expect a lot of temptation to reduce their own exposures in Aterian as soon as there are tendencies to go higher. In other words, we should definitely wait and see where the stock price is going to land, as we haven't seen the end of tunnel on this one yet. Keep in mind that the bottom of the stock so far has been $3.12, and it's now below that region. We should see whether the stock can find a support somewhere. My recommendation is to make sure that your exposure of Aterian remains below 1% of your portfolio and to keep an eye out for any potential support in sight. At this point, I think that a realistic profit target should be between $3.50 and $4, other than a multifold potential if the short squeeze actually succeeds. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks been shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.